So the CPI number just dropped. Markets are sizing up inflation, but amidst the chatter, everyone's suddenly talking about tariffs and as the next big threat. I'm not really sold on that, and I don't think you are either. So yes, tariffs are real. Where no one's denying that, but for now, they're more of a can-kicking game than a crisis that we're questioning. Really, is it a crisis? Because the latest CPI number just dropped. You guys saw it today. You saw the market's reaction, but there's only really one number that we have to know. And that number is simply 1.68%. It's not the inflation number. It's that thing right over there, the market, the S&P 500, the thing we love so truly and dearly. After falling nearly 21%, we're 1.68% away from all-time highs. We are on the verge of basically having every bear scream bloody murder. Oh, and by the way, we hit a weekly higher high on Monday and Tuesday and held it. So it's perfectly right to say that if the number came in, amazing. And again, I'll share with you guys the exact levels that we went over in the weekend deep dive video. It will be linked in the description below as well. And do I think the CPI number came in bad, right? Again, I don't know the number. You guys are seeing it. You're seeing the market's reaction. We're going to be talking mainly about what's next, right? What's next for the market? I don't personally think, and this is just my opinion, that this number came in the way that everyone was expecting it to. And the reason I'm saying that is because it doesn't add up. Something's not adding up, right? We're being told that the inflation numbers, and this is going to be the inflation year over here, but the tariffs really never held up for a long period of time. Oil was down significantly, so energy is still going to be a negative weighting on the CPI. It's also the year-over-year number you're building on a similar year to the previous one. We're also going to be covering this in a live stream in T-minus 3 hours, so make sure you guys are subscribed to the channel to know when that actually comes out, and we banter, throw out all your tickers on the chat and answer your questions live, so make sure you guys join for that. We'll be talking about this CPI report, expected 2.9 and 2.5. I personally think it's going to come in at like 2.7, 2.6, and 2.2, 2.1 for the CPI, giving you a bit of a range, but I think it's the more hunky-dory scenario. I could have complete egg on my face completely right now. So again, throw in the comment section where you were thinking that inflation was going to go. Did you think it was going to go up? Do you think it was going to go down? And obviously yields are going to be the early warning sign prior to the print that we could gain some clarity of what the markets were thinking. And simply put, when we were looking at yields, we weren't really seeing that yields were pushing massively, right? So if we look at the report, we look at yields prior to them push, this is like a meh, right? This is not me saying or the bond market saying that there's inflation. It's more of like, well, we don't really believe the report. And subsequently, we're kind of in this wait and see, go and see era on top of Bitcoin crossing the 110 threshold, right? Trying to get back up to that 120 point, just absolutely destroying any bears that are out there. The same way the market was destroying any bears that were out there, right? Pushed to new weekly all-time high, crossed this 100 threshold number. That was a psychological number. You had stocks like Nvidia, Meta rallying today, even Apple after its lackluster event. And I'll be doing a video in the future about their liquid glass thing, which throw in the comment section below what you think of that. I really want to know your insights about that. But looking at the NASDAQ, right, broke above the 533 number that we gave out. NASDAQ is subsequently only before the opening of today, 1.14%. That's basically nothing for the NASDAQ. We could cover that in just a matter of a heartbeat. And how can you profit from this, right? That's the natural question that everyone's asking. Buy more, and buy more, right? Everyone's been telling you that these tariffs are coming, that the tariff inflation is going to be here, that Jerome Powell is not going to cut rates. Okay, take all the bad news as just more opportunity for you to get the discounted price that you're not going to get in the future. Oh, FYI also, the purple line is the standard close for the previous year. We are approximately only 4.56% when the NASDAQ traditionally returns 15 to 20% year over year. So that means there's a 10% upside to the standard trend that it has been for the last 30 years. Are you really willing to bet against the market? Considering the market also did 21% in 2 months. So yeah, like I wouldn't be betting against that. But anyway, stocks like Nvidia, for example, trying to get back to all-time highs. We could see a massive rally, maybe challenging the 150 number. We also see AVGO after its latest earnings in this upper region trying to find a base here. Could be an excellent buying opportunity for it if you're trying to get semiconductors and don't necessarily want to join the NVIDIA hype train. Apple, as much as I don't like where it's at, again, bashing its head against the 50, and that's why I mainly don't like it. I think people are too leveraged on Apple. I think companies like Netflix kind of giving you a discount here, maybe trying to come back down to this 1,161. I foresee in the next earnings a 10-to-1 split coming for this company because this evaluation that's currently at is going to struggle to keep pushing from a psychological standpoint and ownership of shares. We also saw JP Morgan, right? Bank sector. That's where we want to be looking at as well. It's going to be highly influenced by the CPI number, is pushing, trying to get back to its all-time highs. So wherever you look, there's value to be had. If you're looking for dividends, there's SCHD that's trying to get back above this 200-day moving average right before the massive drop. So again, the Russell, SCHD, JEPQ, they're all areas where you can basically go and buy right now. And then dollar cost average if we get any bad news. But here's the thing. Everyone told you that there was going to be more bad news after this area right here, and it didn't come to fruition. So basically, by listening to them, you missed out on this massive opportunity that was presented. And we also talked about, like, everyone's saying the Fed, right? Jerome Powell, the Fed, looking at what it needs to do. Here's the odds for December prior to the report, right? So this is the odds before December. There's only a small proportion of people that believe that 8.7% will be no rate cut this year. 31 and 39% believe between 1 and 2 rate cuts this year. I'm more in the camp of one all the way on the left, considering that inflation is not going to come in as hot as everyone is expecting, thus resulting in Jerome Powell finally having to have egg on his face, and I cannot wait for that Fed meeting. We're going to be live reacting to it. So again, make sure you guys are subscribed to the channel. That one is going to be a bit of a black eye for the Fed because, simply put, it's just going to be there's no data to support your conclusion after you're being data dependent. So again, we don't want to get complacent either, right? Because we're going to, if we shrug off the tariffs and maybe something evolves from them, we have to be surgical with it. And simply put, I'd be looking to be bullish the market. Also, why am I saying that so fervently? If you don't follow net speculative positions, this is where it comes in handy following these guys. Net speculative position is published by this CFTC every single week, and it allows us to see what people are long or short the market. Right now, there's 70,000 contracts that people are shorting as we're about to break to all-time highs. Let me just refresh your memory what happened the last time we were here. Oh yeah, we ran up 30%. As much as I don't like Tom Lee necessarily, I do agree with him on certain things, and I think it's like a broken clock record thing with him. It's my personal opinion. But I think that we're going to see a massive rally in the markets considering through the summer because statistically, hedge funds need to make money. Their clients are basically demanding to them, like, why aren't you making any money? And the only way to do that right now is to buy the hell out of the market because everyone's sick and tired of being fed this bear narrative. It is just life draining, right? No one wants to hear it anymore. And we're still in greed. We could be touching extreme greed. Again, we went, just to refresh everyone's memory, we're in extreme fear for like 2 months. That means I want to see that dang 100 touched. I want to see 98. I want to see something ridiculous in the market because it's a balancing act. The market goes from one extreme to the next. Again, we haven't really got that catalyst. Once the Federal Reserve starts cutting rates and the yield curve starts looking more like a standard yield curve, and for all those that don't know what the yield curve is basically, the long story short, is when the comparison between longer dated risk and shorter dated risk. If I loan you money for 2 years, then I don't have as much risk versus 10 years, there's more risk. I'm going to demand a higher percentage from you. In the standard scenario, it's like this. In an inverted yield curve, it's like this. What it results in is all the banks losing money because they borrow on this end and loan to this end. If I borrow higher and lend lower, I'm losing money. That's the too long didn't read version about a yield curve. But this is the yield curve right here, and where we got back from uninverted territory, and now are in this period of like kind of waiting to see what's going to happen. The two white lines, which are dashed, are the reversal of 2008 and the dot-com significant points. I don't foresee that happening, right? Like I'm just correlating to this because I think the Fed is running out of options to keep rates higher. The market is not having as much of an appetite for bonds as everyone is thinking. And subsequently, it's leading to greater things that are going on in the bond market, like TLT, just maybe finally getting above this $85 mark. Hold your horses for that one, right? It's in this point where I'm just like, can we stop talking about bonds, please? Like, I would just love to stop talking about bonds. But anyway, short term, I'm looking for the rally on the CPI. Midterm, I'm looking maybe to hedge a little bit just in case anything happens and maybe we get a discount opportunity, but I'm hedging through having cash on the side to buy amazing companies discounted for amazing prices. And long term, I don't think the tariffs are going to be in any way, shape, or form realistic. Make sure you guys tune into the stream to know what exactly happened. You'll get us raw, uncut version there of what happened with the tariffs and CPI inflation, the prediction for the next CPI report, and more great analysis like this. Hopefully this was helpful for you to understand tariffs, inflation. They're just kicking in the can down the road. Throw in the comment section what you think, and make sure you guys stay tuned for the live stream. Thank you all so much for watching, and I'll see you in the next one. The 2 latest videos are also posted over here along with the Discord, so make sure you guys check that one out.